You're standing in a shop in your new country. New apartment, new job, new life. You tap your card to pay for groceries. Declined. You try again. Declined. You check your phone and there it is. A message from the bank you have used for 20 years. Your account has been restricted. Pending review. You did not miss a payment. You did not overdraw. You did one thing. You told them you moved abroad. In the last video, we covered the 5 rules that decide what a new country does to your money. Today is the rule nobody warns you about. The moment your bank learns you have emigrated, it can freeze your account, close it, or quietly strangle it. And the reasons have almost nothing to do with you. Here is the uncomfortable truth. To your old bank, you were a profitable low risk customer, right up until the day you became a foreign resident. The moment your address crosses a border, you flip from an asset to a liability on their compliance spreadsheet. Think about what a bank now has to do to keep you. It has to understand the tax rules of your new country. It has to report your account under international agreements. It has to check you against the sanctions and money laundering rules of a jurisdiction it may barely operate in. And it has to do all of that for one customer whose fees might earn them a few hundred a year. For a retail bank, that math does not work. The cheapest, safest option is not to serve you better, it is to not serve you at all. This is called de-risking and it is a deliberate policy. Whole categories of customers, expats, foreign residents, anyone who looks like paperwork, get shown the door. Not because they did anything wrong, because the risk of keeping them, however small, is no longer worth the reward. So, what flips the switch? It is rarely one dramatic event. It is usually something small and administrative that you do yourself. Trigger 1. You update your address. The instant a foreign address lands on your file, automated compliance systems flag the account for review. Trigger 2. Your tax residency changes. Under the Common Reporting Standard, your bank now has to identify where you are tax resident and report your balances there. If you will not or cannot confirm your new status, some banks simply close rather than guess. Trigger 3. A routine review finds you. Banks recheck existing customers in batches, and a foreign phone number, a login from a new country, or a transfer to an overseas account can all surface you. Trigger 4, and this one is brutal. You are American. Under a law called FATCA, foreign banks must report accounts held by US citizens to the American tax authorities. And the compliance burden is so heavy that many banks outside America refuse US customers outright. An accident of citizenship and doors close before you even knock. None of these triggers is an accusation. They are just the tripwires that move you from the keep pile to the review pile. And review, too often, means exit. A freeze is rarely a clean, honest, we are closing your account. It arrives in layers, and the first layers are deniable. First, the soft freeze. Your card starts getting declined abroad, online transfers to certain countries fail. Your banking app logs you out and demands documents you cannot easily produce from another continent. Officially, nothing is wrong. In practice, your own money is behind glass. Then, the information request. A letter or message asking you to confirm your address, your tax residency, your source of funds, sometimes within an alarmingly short deadline. Miss it, misunderstand it, or fail to get a document apostilled in time, and the account moves to the next stage. Finally, the closure notice. Most countries require a bank to give you notice, often 30 or 60 days, before closing a personal account. That sounds fair until you realize your salary is paid into that account, your direct debits run from it, and you now have weeks to rebuild your entire financial life from abroad, while the balance itself may be held until every check clears. The cruelty is not malice, it is process, running exactly as designed. Now, the part that makes people angriest. In most countries, the bank is allowed to do this. Your account agreement, the one nobody reads, almost always contains a clause letting the bank close the relationship for broad reasons, with notice and without a detailed explanation. Anti-money laundering law often forbids the bank from even telling you why. That silence is not rudeness. In some jurisdictions, explaining the closure would itself be a crime called tipping off. So you get the outcome with no reason, no appeal to a human who can help, and a call center that genuinely does not know. The regulators are aware. In several countries, forced account closures of expats and law abiding foreign residents have become a political issue, and rules are slowly tightening to require better notice and fairer treatment. But slowly is the key word. Today, if your bank decides you are more paperwork than profit, your main protection is not the law. It is having set things up in advance so that no single bank holds the power to cut you off. Which brings us to the part you can actually control. 3 moves keep your money reachable. Move 1. Never depend on a single bank in a single country. Before you move, open an account with a global or multi currency provider, one built for people who live across borders. The names change by region, but the category is the same: banks and fintechs that expect a foreign address instead of panicking at one. If your home bank later freezes you, your financial life does not stop. It just shifts to the account that was never going to flinch. Move 2. Tell the truth, early, on your terms. Counterintuitive, but the customers who get frozen are usually the ones who went quiet, hoping nobody would notice the move. Silence is exactly what compliance systems are built to punish. Instead, proactively update your details, confirm your new tax residency, and provide your new tax number before they chase you. A bank that has clean, complete information from a cooperative customer has far less reason to reach for the closure button. You are not hiding from the system, you are handing it exactly what it needs, so it has no excuse to act. Move 3. Keep a bridge open in your old country, deliberately. Do not close every home country account the day you leave. If you can, keep one account that permits non resident holders, ideally at a bank with an international arm, and keep it clean, funded, and active. It becomes your bridge for pensions, refunds, and any income that stubbornly stays behind. So here is the survival checklist. Screenshot this. 1. Open a cross border or multi currency account before you emigrate, not after. 2. Update your address and tax residency proactively in writing. 3. Keep one non resident friendly account open in your old country. 4. Never let your salary and your only card depend on the same institution. 5. Keep certified copies of your ID, proof of address, and tax number ready because the day they ask, the clock is already running. Your bank does not freeze you because you did something wrong. It freezes you because, on a spreadsheet, you became expensive. Set up your account so no single bank holds that power, and the freeze becomes a shrug instead of a crisis. But moving the money is its own trap. Once your accounts are safe, you still have to send savings across borders, and that is where the next ambush waits. Transfer limits, source of funds interrogations, and exchange rate spreads that quietly skim thousands of every large transfer. How the money actually moves between countries and the mistakes that freeze it in transit. That is the next video on your screen right now. Watch it before you move a single large sum.